welcome to this session of GFAS Global Financial Accounting Standards. In today's session, we shall learn something about the trial balance and the balance sheet. What are the items which are required to be taken into account for the final balance sheet, as well as what is to be done after the trial balance has been taken. So these are the two important things that we are going to do in today's session. And let me remind you that 23rd, that is tomorrow, you have got your first cycle test, and the portion up to the first cycle test is up to what we are doing today, up to today's session. Up to today's session, that is the portion for your first cycle test. So what are we going to learn in today's session? In this session you will learn, identify all the key steps in the record to report accounting cycle. Understand the trial balance, its meaning and significance. Apply the knowledge to post-adjustment journals after the first trial balance. Apply the knowledge of preparing the balance sheet and income statement with a case study, and generate adjusted and closing trial balance. So these are the things that we are going to learn in today's session. Steps in the preparation of a financial statement. The various steps involved in the preparation of a financial statement are: number 1, identify recordable financial transactions. Recordable financial transactions are those transactions which are monetary in nature, money related. Number 2, complete posting of transactions in accounts payable, account receivable, general ledger, banking and fixed assets. Number 3, extract the preliminary unadjusted trial balance. So these first three, this relate to the normal regular accounting. First three, 1, 2 and 3. This relate to the normal accounting. From the fourth point onwards, these are done at the end of the accounting period. All these will be done at the end of the accounting period, that is reporting date. As on the reporting date, number 4 onwards, these steps are taken. So number 4 is record adjusting journal entries. Adjusting journal entries relate to the accrual and deferral. All these accrual and deferral, already we have learned what is accrual and deferral in the last session. So these accrual and deferral amounts, these have to be accounted for at the end of the accounting period, along with other items like depreciation, provision for doubtful debts, provision for obsolete inventory. All these are also to be recorded, and these are called the adjusting journal entries. These adjusting journal entries are important because these are essential as far as the accounting standards are concerned. Unless we do these adjusting journal entries, we will not be following the accounting standards. So in order to follow the accounting standards, it is essential that these adjusting journal entries are taken into account. Number 5, prepare the adjusted trial balance. Number 6, prepare the income statement or comprehensive income statement. Number 7, transfer profit to the retained earnings. Number 8, prepare balance sheet, that is SOFP, SOCIE and SOCF. SOFP, Statement of Financial Position, SOFP, Statement of Financial Position. SOCIE, Statement of Changes in Equity. And SOCF, Statement of Cash Flow. All these we shall do during the course of this session. Number 9, close temporary account, that is account receivable, account payable, banking, fixed assets, as well as temporary accounts are mainly the income and expense accounts, revenue and expense. So these have to be closed. That is very important. And number 10, post the closing trial balance. Post the closing trial balance. So these are the steps to be taken in the final preparation of the financial statement. The balance sheet is also called the Statement of Financial Position, SOFP. SOFP. That is called the balance sheet. So these are the steps in the preparation of the financial statement. Excuse me. Okay, trial balance, meaning and significance. What is the trial balance and what is the significance? Significance means importance. What is the meaning and what is the importance of the trial balance? First point, it is a statement of all general ledger accounts with names and their respective balances. General ledger accounts consist of the assets and liabilities. Excuse me. It is a summary or extract of the main ledger position of a business as on a particular point of time. That means it is as on a date. Third point, the purpose of preparing a trial balance is, number 1, it is the starting point for producing an income statement and the statement of financial position at the end of the accounting period. So trial balance is the starting point for two very important vital financial statements. One is the balance sheet, which is called the statement of financial position, and the second is the income statement, which we popularly known as profit and loss statement. Second position, it ensures completeness in the double entry system and arithmetical accuracy. Redundant in the ERP environment. Redundant means no longer applicable. In the ERP, enterprise resource planning, nowadays everything is done through the system. Since everything is done through the system, this arithmetical accuracy is no longer an issue to be taken into account, because the system will automatically balance the debits and credits, and when the trial balance comes out, you will see that the debit side is equal to the credit side. The asset total of the asset side is equal to the total of the liability side. And the last point is, it assists during review and audit. During audit, the balance sheet is a very important statement which the auditors would like to see and ensure that various accounts are adjusted, various ledgers are adjusted, all accounting principles have been followed. So this financial statement is very important. Similarly, for review also, what is the position of the organization? What is the business position of the organization? So the trial balance is one of the important statements which are to be taken before the preparation of the final balance sheet and income statement. Features of a trial balance. What are the features of a trial balance? It is a statement and not an account. So what is a trial balance? It is a statement. It is not an account. Second point, it is at a point of time or as on a date and not for a period. Trial balance will be as on a point of time, as on a particular date, as on today, as on 31st of March, in that way. The three stages in the preparation of the trial balance are unadjusted trial balance, adjusted trial balance, post-closing trial balance. So these are the three stages in the preparation of the trial balance. In the next slide, we shall see what are these three stages. Limitation of a trial balance. There is some limitation, that means there is some drawback of the trial balance. What is it? It does not help to detect omission errors, journalizing errors, offsetting errors, reverse journal errors. These type of errors, it is difficult to find out by taking a trial balance. If you take a trial balance, you will see that both the sides are adjusting. Credit side will adjust with the debit side. Asset side will adjust with the liability side. But if there are errors, then such errors cannot be detected by means of this trial balance. So that is one major drawback of the trial balance. Suppose, for example, one item has been omitted totally. Both debit side and credit side, entire transaction has been omitted, left out. The trial balance would still tally, but there is an error. Similarly, if there is an error in the credit side, there is also an error in the debit side. Two mistakes are happening. One mistake is made in the debit side for 1,000 rupees. Another mistake is made in the credit side for 1,000 rupees. Both the sides will tally. Both the trial balance is tallying, but there is an error. Such type of error are called offsetting error. One error is cancelling out the other, offsetting error or compensating error. So this type of errors, it is very difficult to detect by means of the trial balance. The following figure represents the different stages in the preparation of the trial balance. First, unadjusted trial balance. What is this unadjusted trial balance? This is the first version of the trial balance generated from the system. First version. That is called unadjusted trial balance. That means the adjusting entries are not taken into account as far as this trial balance is concerned. No entries are made. Only the trial balance has been taken from the system. Second, adjusted trial balance. In this adjusted trial balance, various adjustment entries are taken into account. As I told you, the deferral, accrual, depreciation, then provision for doubtful debts, provision for uncollectible items, then provision for obsolete inventory. All these items have to be taken into account. These items are required as per to meet the compliance of the accounting standards. So once these items are taken into account, accrual, deferral and various provisions, depreciation, once these items are taken into account, the trial balance that you get is called the adjusted trial balance. So adjusted trial balance. It is the last version generated immediately before preparation of the financial statement after correction of errors, adjustments and compliance to GAAP and IFRS. So after various errors have been rectified, after various adjustment entries have been passed, after that the trial balance that you get is called adjusted trial balance. Then finally we are having another type of trial balance which is called post-closing trial balance. As you can see on your screen, it is generated after the preparation of financial statements. After the financial statements have been generated, this post-closing trial balance is taken. Post-closing entries and closing of the accounting period, it contains only the closing balance of balance sheet accounts and no temporary accounts. So the main purpose of this post-closing trial balance is to ensure that there are no temporary accounts in the trial balance. That means the trial balance do not contain any items of temporary accounts. What are temporary accounts? Temporary accounts are those items of revenue and expenses. All items of revenue and expenses are called temporary accounts. Please remember that. All items of revenue and expenditure are called temporary accounts. Why are they called temporary accounts? Because all these items are closed at the end of the accounting period and they begin the next accounting period with zero balance. So that is the reason why such type of items are called temporary accounts. All items of revenue, all items of expenses, these are called the temporary accounts. So the post-closing trial balance, the main purpose of this post-closing trial balance is to ensure that all items of income, that is revenue, and all items of expenses are having zero balance and they are not finding a place in the post-closing trial balance. So no temporary items should be there in the post-closing trial balance. That is the main purpose of taking out the post-closing trial balance. So these are the three stages: unadjusted trial balance, adjusted trial balance, and post-closing trial balance. Adjustment process. Adjustment, as I told you, adjustment means all accrual, all deferral, depreciation, adjustment for taxes, provision for doubtful accounts, provision for obsolete stationery, all these items are to be accounted for. This entire process is called adjustment process. And the items which are accounted for, these are called adjustment items. So, after the trial balance is taken, we have to ensure that all these items are accounted for, and then the trial balance that we get, as we saw, that is called the adjusted trial balance. So, a trial balance is reviewed and the GL, that is general ledger, are posted for number one, correction of errors such as journalized to wrong GL, omission, any amount, any item that is left out, that is called omission, reverse posting, any item which is posted wrongly, principal mistake, mistake of any accounting policies, these are taken into account. So all these have to be corrected before the adjusted trial balance comes out. So all types of correction, it may be correction of error, correction of entry, omission of entry, reverse posting, wrong posting, principal mistake, mistake in applying the accounting policy, all these corrections have to be made. Second point, adjustments at the period end to record internal transactions and events that are not yet recorded. For example, deferral and accrual. All accrual and deferral have to be accounted for at the end of the adjusted, at the end of the reporting period. So this is very important. These are called adjustment items. So adjustments at the end of the period to record all internal transactions and events that are not recorded. For example, if a sale is made, a credit sale has been made, then you have to account for that. That is called the accrual basis of accounting. Debit account receivable, credit sales account. So what am I doing? Revenue is recognized. Similarly, if there is a sales commission to be paid, then debit sales commission, credit expenses payable. You credit your liability account. So what has been done? All income that has accrued has been accounted for. Similarly, all expenses that have accrued have been accounted for. Now, in the case of deferral, In the case of deferral, cash is received in advance or cash is paid in advance. Prepayment, we call it prepayment. In such cases, you cannot account for those amounts in your income and expense statement. You have to debit a separate account called prepaid account or unearned revenue account, so that those will be asset or liability accounts. Third point, compliance to IFRS and GAAP and other statutory requirements. So this is very important that you have to ensure before the final trial balance is taken that all accounting standards have been followed. The two basic principles for recognizing revenue and expenses. What are the basic principles that must be followed? All of you know that. First, revenue recognition principle, and second is the matching principle. What is the revenue recognition principle? Revenue recognition principle requires revenue to be recorded when earned, neither before nor after. So, if a revenue has been earned, it must be recorded. As I give you the example, if a sale is made, a credit sale has been made to a buyer. Buyer will pay after 30 days. But accounting has to be done today. Why? Because you have made the sale. So debit account receivable, credit sales account. So you are recognizing the revenue. Similarly, whenever there is a revenue, whenever you are accounting for a revenue, the related expenditure must also be accounted for. So whenever there is a sale, what is the related expenditure? Cost of goods sold. So debit cost of goods sold, credit inventory account. So you are debiting your expenditure account, reducing the inventory to the value of the items which is sold. Similarly, if there is a commission which is payable, a sales commission related to that sales commission also has to be accounted simultaneously. So this is called the matching principle. So the second point, the matching principle requires expenses to be recorded in the same period as the revenue earned as a result of these expenses. So these are the two very, very important principles that we have to follow. First is the revenue recognition principle, and second is the matching principle. Revenue recognition principle says revenue has to be accounted for when it is earned, and matching principle says whenever there is a revenue which is accounted for, the related expenditure must also be accounted for. An adjusting entry is recorded to bring the asset and liability account balance to its proper amount. That is the reason why adjusting entries are essential. Adjusting entries are essential in order to take care of all the accrued items, whether it is revenue item or whether it is expense item. Similarly, we have to take care of all the deferrals. If money is received in advance, we cannot take it to income account. Similarly, if money is paid in advance, prepayment, then also we cannot debit our expenditure account. So these are two important things we must understand. So you can see the adjustment process. It is based on accrual accounting, revenue recognition, matching principle. In the last slide we have talked about these items. So what is the adjustment process? The adjustment account involves the following steps. First, determine the current account balance. Number 2, determine what the current account balance should be. Number 3, record adjusting entry to get from step 1 to step 2. So here the word current means present, now. What is the present balance? Current means present. Please remember that. It is not current account we are talking about. When we talk about this current, what the word current that is there, here in this context, the word current means the present. Please remember that. So determine what is the present balance. Determine what should be the present balance and vouch for the difference amount. So step 1, step 2 and step 3. Step 3 is the adjusting entry. So adjusting entry has to take care of all the accrual, deferral, depreciation, provision for doubtful debts, provision for obsolete inventory, provision for various uncollectible items. All these have to be taken into account. Only then we can say that the accounting standards have been complied with. Let us see with some examples. During 2013, ABC purchased 15,500 of supplies. ABC recorded expenditure as supplies, that is asset account. On 31st December, that is closing date, the end of the reporting date, account of supplies indicated 2655 on hand. What is the adjustment required? So, let me tell you first what is the procedure. In an organization, whenever any consumable item is purchased, this consumable, it may be stationery, it may be various other items of various other items required for running of the office. So, or any type of office item, whenever these are purchased, they are purchased to the debit of supplies account. Supplies account is an asset account. So, when an office purchases any consumable item, it may be stationery, it may be any other consumable item, what is debited is asset account. Supplies account is debited. Supplies account is an asset account. At the end of the reporting period, it may be 31st March, it may be 31st December, what is the total stock left that is found out? And then for the difference amount, expenditure account is debited. So that is how the procedure takes place. So you can see the following table represents the adjustment for the inventories. 31st December, debit supply expense 12,845. Credit supplies account 12,846. So what happens is 15,500 is the total supply which has been purchased, and at the end of the reporting period the balance of consumable is 2655. So 15,500 minus 2655, amount is 12,845. This is the amount of supplies which have been consumed by the organization for one full year. 15,500 minus 2655, amount is 12,845. So this is the total consumption by the organization. So what will the organization do? Debit supplies expense, that is an expenditure account, and credit supplies account, asset account. So what is the balance in asset account at the end of the period? 2655. At the beginning of the period, the asset account, that is supplies account, had a balance of 15,500. This has been reduced by 12,845, and the balance as of 31st December is 2655. So as you can see in the table. So what is done here is, any expenditure which has taken place during the accounting period, that has to be recorded. That is the main important thing. So these are called the adjustments. Adjustment entries. At the end of the period, adjusting entries are required to satisfy the realization principle and the matching principle. These are the most important accounting principles: realization principle and the matching principle, revenue recognition principle and the matching principle. These are two very important accounting standards. So the necessary situations for adjustments are: number one, prepayment. Transactions where cash is paid or received before a relative expenditure or revenue is recognized require adjustment entries. Similarly, second, accrual. Transactions where cash is paid or received after the related expenditure or revenue is recognized requires adjustment entries. And third, estimates. Accountants must make estimates in order to comply with accrual accounting model. Any estimate, maybe estimate of the doubtful debt, estimate of uncollectible items, all these are estimates. Depreciation, that is also an estimate. So these are the three important items which are to be taken into account before the final balance sheet is prepared. Prepayment, that is deferral, accrual, and all estimates. All these have to be taken into account, and all these three together are called adjustment entry. So you can see this 31st of December, debit depreciation expense 200, credit accumulated depreciation 200. So here depreciation has been taken into account. Depreciation expenditure has been taken into account. And what is credited? Accumulated depreciation. This is a contra asset account. Accumulated depreciation is an asset account, but with a credit balance. This is just below the property, plant and equipment. In the asset side, just below property, plant and equipment, there is one more entry is there, one more asset account is there called accumulated depreciation. This type of accumulated depreciation account is in credit balance, and it is called contra asset account. Why contra asset account? Because all asset accounts are in debit balance, but this accumulated depreciation is in credit balance. So that is the reason why it is called contra asset account. Please remember this important thing. Contra asset account means it is the accumulated depreciation which is in credit balance. Accumulated depreciation which is in credit balance. So it is called contra asset account. This accumulated depreciation, it is in the same side of the property, plant and equipment, in the asset side of the balance sheet, but it is below the property, plant and equipment, and to find out the net amount, we have to reduce the amount of property, plant and equipment from the accumulated depreciation. Rituparna from New Panbazar, please repeat accumulated depreciation. Okay, I hope all of you know what is depreciation. Depreciation is the amount of expenditure which is debited for the wear and tear of the value of an asset. The value of the asset, the value of any asset, property, plant, equipment, any asset, fixed asset, the value will go on reducing. Why? because of regular wear and tear. Say for example, one car. The value of the car, new car, in the showroom is say 2 lakh rupees. As soon as it comes out in the road and it is driven, the value will fall below 2 lakh rupees, maybe 1,90,000, 1,80,000, whatever it is. So the value of the asset is falling. So in our books, we have to ensure that depreciation amount, that is the fall in value of the asset, is taken into account. So what do? We debit expenditure account depreciation, credit accumulated depreciation. Accumulated depreciation means the depreciation which is charged for the particular asset over a period of time. Say first year depreciation is 200 rupees, second year depreciation is 300 rupees, fourth year depreciation is 500 rupees. When all the total is made, then this total depreciation is called accumulated depreciation. Accumulated depreciation appears in the asset side. It is an asset. Accumulated depreciation is an asset account, but it is an asset account with a credit balance. Normally, all asset accounts have got a debit balance, but this is an asset account with a credit balance. Hence, it is called a contra asset account. And if you want to find out what is the value of an asset, we have to reduce the accumulated depreciation from the asset amount to find out what is the value as on today's date. Depreciated value. Next, adjustment for unearned deferred revenue. When accounting for deferred revenue, we face a transaction where cash is received in advance. That is, before providing a product or service. When dealing with adjustment for deferred revenue, a liability account is debited or reduced and a revenue account is credited or increased. So what do we do? When money is received in advance, goods have not been sold, service has not been provided, but money has been received in advance. When money has been received in advance, this money cannot be taken to income account. It has to be kept separately in the liability account. And this amount which is kept separately in the liability account is under the head unearned revenue. So you can see on the right side of the liability account, unadjusted balance. So this is the unearned revenue which is there. And when the goods are sold or when the service is provided, then we will debit liability account and credit the revenue account, as you can see in the screen. So whenever, in the case of deferred revenue, whenever money is received in advance, the money has to be kept in a separate liability account, credited to liability account, under the head unearned revenue. Subsequently, when the goods are sold or the service is provided, the money which is lying in the liability account will be debited. Debit unearned revenue, credit revenue account. So revenue will subsequently be recognized only when the goods are sold or the service is provided. So this is the accounting for unearned revenue. Let us see an example of adjusting unearned revenue. See the example, you will understand. On 25th of October, ABC Consulting has received a payment of 1 lakh from its client. How much money has been received? 1 lakh. Which date? 25th October. Services being rendered have been postponed till December. When will the service be provided? In December. When has the money been received? In October. Money has been received in October. Service will be provided in December. So money has been received in advance. So what will the company do? Debit cash, credit, liability account, unearned revenue. So you can see the accounting. Debit cash, credit unearned revenue, 1 lakh. So liability account, unearned revenue is credited with 1 lakh because this money has been received in advance. No service has been provided. Service will be provided only in December. Only then you can credit your revenue account, not before. So this 1 lakh is kept under the liabilities account. Now let us see what happens next. Later, ABC Consulting provided half of its services to its clients in the month of December. In the month of December, only half of the service was provided, 50%. The service value is estimated at 50,000. So, in the month of December, since half of the service was provided, estimate of the service is 50,000, so you can debit your unearned revenue account, liability account and credit your revenue account to the extent of 50,000 only, not 1 lakh. Please remember, here only 50% service has been provided. So you can credit your revenue account only up to 50,000. So what happens? Debit unearned revenue liability account 50,000, credit revenue account 50,000. So revenue account has been credited for 50,000 and unearned revenue liability account balance 50,000 still remains. Only when the remaining service will be given, the remaining amount of 50,000 can be taken to your income account. So what have we learned? Whenever money is received in advance, that money has to be kept in a liability account called unearned revenue. As and when the goods are sold or the services provided, only then you can credit your revenue account. Debit liability account, unearned revenue, credit revenue account to the extent of the goods or services provided. So what is this concept? Deferral concept. This concept is the deferral concept. Adjustment for accrued expenses. Accrued expenses are those expenses which have fallen due. Any expense which has fallen due is called accrued expense. Accrued expenses are costs incurred in a period which are both unpaid and unrecorded. So such type of expenses, money has not been paid, but since the expenditure has already been fallen due, I have to debit my expenditure account and keep the money separately in a liability account called expenses payable. It may be, say for example, interest accrued and payable. That is the liability account, where any interest amount which has fallen due, I will be keeping separately. So, accrued expenses are the cost incurred in a period which are both unpaid and unrecorded. For all accrued expenses, adjusting entries, an expense account is debited and a liability account is credited. So what are we doing? Whenever there is an expenditure, we are debiting expenditure account. You can see the figure. We are debiting expenditure account and crediting liability account. We are debiting expenditure account and crediting liability account. When the time comes for payment to that person, when the person comes and says, give me my payment, I will debit my liability account and pay him the money. I will not debit expenditure again because expenditure has already been debited earlier. This is the concept of accrual. In the case of accrual concept, any cost which is incurred, I will debit my expenditure account and credit my liability account. Accrued expenses. I will credit my liability account, accrued expenses. Say for example, I gave you the example of sale has been made. Revenue has been recognized when the sale is made. Now the related expenditure, that is the sales commission, I have to debit my expenditure sales commission and credit my liability account, accrued expenses, that is liability account. When the salesperson will come to the bank or when the salesperson will come to the organization, at that time I will debit my accrued expense liability account and pay him the money. So that is how adjustment is made to accrued expenses. Let us see with an example. See the example. ABC pays employees every Friday. What is the payment date? Every Friday. Year end 31st December falls on a Wednesday. As of 31st December, employees have earned salary of 47,250 for Monday through Wednesday. That means every Friday payment is made. So Friday, you can see in this the date which is mentioned. Friday date is 26th. 26th of December is Friday. Next payment will be made on next Friday. Next payment will be made on next Friday. That is 2nd of January. In between, 31st of December is falling. 31st of December is the annual closing date or the reporting period. So on the reporting period, whatever salary has fallen due, that has to be accounted for. So we have to calculate what is the salary fallen due, and it is given here. The salary which has been earned is 47,250. So what I will do is, I will debit my salary expense account and credit liability account salary payable. Salary payable is a liability. So this is another example of accrued expenses. Any expenditure which has fallen due for payment, that has to be provided as on the closing date. Please remember that any expenditure which has fallen due has to be provided for as on the closing date. Don't forget this, very important thing. So see what is the expenditure that has been, what is the adjustment entry that has been passed. 31st of December, salary expense account, debit 47,250, salary payable account, that is a liability account, credit 47,250. So as you can see, salary payable account as on 31st of December, balance will be 47,250. So next Friday, which is the payment date, that is 2nd of January, this 47,250 will be debited along with any excess amount for the next 2 days. That also will be debited and payment will be made to the staff. So salary payable account, this is the liability account. So what is happening? In the case of accrued expenses, Accrued expense means any expenditure that has fallen due. On 31st of December, expenditure for salary has fallen due. For how many days? From the 26th of December, that is, from 26th of December payment has been made. That means from the 27th of December to the 31st of December. For this period, the salary has fallen due. What is the amount of the salary? 47,250. So, since 31st of December is the closing date, I will debit salary expenditure, credit salary account, salary payable account. So, salary payable account, it is a liability account. I will credit my salary payable account. So, the balance in the salary payable account is 47,250. On the 2nd of January, Friday, when the salary is due to be paid to the employee, at that time the salary payable account will be debited for 47,250 and any remaining amount expenditure will be debited for the rest of the amount and amount will be paid. So the basic thing we are doing here is that whenever any expenditure has fallen due for payment, then as on the closing date, it may be 31st of December, it may be 31st of March, the amount that has fallen due for payment, that has to be debited to your expenditure account, and we will credit a separate account, liability account, called expenses payable. The salary payable, this is part of the expenses payable account. ABC and Company Chartered Accountant has 31,200 of work completed but not yet billed. Let us make adjustment entry necessary on 31st December 2003. ABC Company has 31,200 of work completed but not yet billed. Let us make the adjustment entry necessary for 31st December. So can you tell me, please raise your hand and tell me, what will be the accounting procedure? What will be the accounting procedure? Please raise your hand and tell me, what will be the accounting procedure? So before that, we'll take a short break of 2 minutes and we'll come back. We'll take a short break of 2 minutes. Okay, welcome back. So can you tell me, please raise your hand and tell me, what is the adjusting entry that you will make in this case? What is the adjusting entry? Please raise your hand. Very simple question I have asked. What is the adjusting entry that you will make in this case? What is the adjusting entry? What is the adjusting entry that you will make in this case? Very simple. What is the adjusting entry that you are going to make in this case? ABC and Company Chartered Accountant has 31,200 work completed. He has already work completed but not yet billed to the client. Let us make adjustment entry necessary on 31st of December, the end of the company's fiscal year, financial year. Very simple question I am asking. What is the adjusting entry you are going to make? What is the adjusting entry you are going to make? Mayank from DCP.
Hello. Yes, sir.
Yeah, Mayank, tell me, what is the adjustment entry that you are going to make?
ABC company has 31 work complete, but it's billed to client. Sir, I don't know.
Please unmute your mic. I'm not able to hear. Please unmute your mic. Yeah. Tell me.
Hello.
What is the adjusting entry you are going to make?
आवाज आ रही?
It's coming. It's coming. Tell me.
Sir, I don't know.
Pardon?
Sir, I don't know.
Don't know. What is the reason why you don't know?
Sir, I will try.
You try.
Account received. Sir, account received debit, service credit, or revenue. Revenue debit, sir.
Yes, correct. You are giving the correct answer. Thank you.
Okay, sir.
Okay, guest come from Satyanagar, you have given the correct answer, but again you are debiting account receivable not to liability account but to sales account. Divakar from South Extension, you have given the correct answer. Debit account receivable, you have to debit account receivable and credit your income account. That is the correct answer. Debit account receivable, see, you have provided the service. The service has already been provided. So as soon as you provide the service, that means revenue can be recognized. So debit account receivable, credit income account. So as you can see, account receivable debit, credit service revenue. This is your income account. So to the debit of account receivable, you are crediting your service revenue, you are crediting your revenue account, and when the money will come, you will reverse the account receivable. That's all. So this is the accrual basis of accounting. This is the accrual basis of accounting. Very simple. Yes, Amir from South Extension, you have given the correct answer. Correct. Very good. Now, before I proceed, let me tell you that 23rd, that is tomorrow, you are having the first cycle test. Tomorrow you are having the first cycle test and the portion will be up to whatever we have completed today. Now estimate. This estimates already we discussed regarding estimates. We have already discussed, and this is one of the important accrual basis which have to be done for estimates. As you can see in the figure, revenue recognition, that is also an estimate. Account receivable that we are debiting, that is also an estimate. It may not be the full final figure, but just an estimated amount we are debiting. Depreciation, it is an estimate. Provision for loss, any doubtful accounts, that is an estimate. Provision for uncollectible account, that is an estimate. Uncollectible account, these are items of account receivable which remain uncollected for a long period of time. So, for these type of accounts, you have to make a provision, because we do not know whether the person who has purchased the goods, whether he will pay the money. So, these are doubtful category of collections. So, we have to keep separately, certain amount of money we have to provide and keep it separately. Sudeep from Rajuri Gardens, tomorrow is cycle test. Yes, tomorrow is the cycle test, correct. 23rd. So, estimates. The accountant must often make estimates of future events to comply with the accrual accounting model. So, if you want to follow the accrual principle, certain estimates have to be made. As you can see, revenue estimate, depreciation estimate for provision of losses, estimate for provision of obsolete inventory, provision for uncollectible accounts. All these types of estimates have to be made in order to comply with the accrual principle. Rituparna says, is it provision for losses or providing for losses? Whatever you call it, meaning is the same. You are providing certain amount of money for the probable loss. We are thinking money will not come. That's why we are taking it as a loss. Actual loss has not happened. So what do? I debit my expenditure account and keep certain amount of money separately for such type of items. Any loss or any uncollectible account. Guest from Satyanadar. Estimate means forecasting for expense or income. Yes. Estimate is approximate amount. Approximate amount. For example, the budgeting that you do, those are also estimates. Whenever any budgeting is done, that is estimate. You are budgeting for revenue, you are budgeting for expenditure, so those are all estimates. Rough amounts. So similarly, for depreciation, for providing for losses, providing for uncollectible accounts, all these are based on estimate. Estimate means it is a matter of judgment. I don't know the exact amount, but rough amount I am accounting for. I don't know whether my loss is going to be 9,000 or 10,000 or 12,000. But I am taking an estimate. Maybe my loss will be 10,000, so I will provide for 10,000. Maybe ultimately my loss will be 13,000. We don't know. But approximate amount, that is what we call estimate. So estimate is made on judgment. It's a very subjective matter. And one important thing you must understand. Estimate is made as on today's date. The situation existing as on today's date, based on that estimate is made. Tomorrow's situation may change. So the estimate made may not be required, or the estimate made may have to be more. So this is one important thing that we have to understand, that estimates are always made as on the situation arising as on a particular date. Estimates will keep on changing. Yesterday's estimate will not be today's estimate. Today's estimate will not be tomorrow's estimate. So estimates depends upon the situation. Today's situation may not be the same as tomorrow's situation. Tomorrow's situation may not be the same as day after tomorrow's situation. So estimates are made as on a particular date depending upon the situation. Subdeep from Rajuri, what do you mean by providing for loss? Providing for loss means, what am I doing? I am debiting my expenditure account and keeping aside a certain amount of money for the probable losses which will happen in future. What am I doing? I am debiting my expenditure account and I am keeping aside certain amount of money which will take care of the loss which will happen tomorrow. So that is the meaning of providing for losses. So let us see an example of unadjusted trial balance in the next slide. Unadjusted trial balance. So this is an example of unadjusted trial balance. That means before the accrual and deferral are taken into account. So you can see two sides are there, debit side and credit side. In the debit side, you can see cash is there, account receivable, supplies account, prepaid rent account, inventory account, furniture account, retained earnings account, cost of goods sold account, salary expenses account. This is on the debit side. Credit side, you can see accounts payable, note payable. Note payable means loans which are taken. Unearned rent revenue, common stock, that is the equity, sales revenue. All these are items in the credit side. And as you can see, the credit side and debit side both are adjusting. 1,74,500 both on the credit side as well as on the debit side. So trial balance is adjusted. So a trial balance is an index of the general ledger GL with respective balances as on a particular date. And most important point of trial balance is the debit side must tally with the credit side. So this type of a trial balance, before any accrual and deferral is taken into account, is called unadjusted trial balance. Now let us see an adjusted trial balance after all adjusting entries have been recorded and posted. So let us see an adjusted trial balance after all adjusting entries have been recorded and posted. Before that, I will again show you the trial balance, unadjusted trial balance. I will show you again so that you will be able to compare. You will be able to compare. All students are requested to see the various items in this unadjusted trial balance. Please see the various items. Then I will show you the adjusted trial balance. And then you have to tell me which are the new items in the adjusted trial balance. So please see the trial balance again. Please see the unadjusted trial balance. This is the unadjusted trial balance. Please see the various items which are there. Please see the various items which are there. And then what we are going to do, we are going to compare with the adjusted trial balance and see what are the new items which are there. So these are the items in the Unadjusted trial balance. These are the items in the unadjusted trial balance. Please see item by item, line by line, item by item, see all the items which are there. And then I will show you the adjusted trial balance. And what you have to do is you have to tell me what are the new items that you can see. Okay. Now, this is the adjusted trial balance. This is the adjusted trial balance. Now, please tell me what are the new items you can see in this trial balance. The following table represents the adjusted trial balance for ABC after adjusting entries have been recorded and posted. So, what you have to do is you have to write down in your exercise book what are the adjusting entries that have been made. What are the adjusting entries that have been made? Please write down in your exercise book. Please write down in your exercise book what are the adjusting entries that have been made. Please see the adjusted trial balance. Please see the adjusted trial balance. After going through the adjusted trial balance, what you have to do is you have to tell me what are the adjusting entries that have been made. Adjusting entry means entries related to accrual and deferral. Entries related to accrual and deferral. Those are the, what are the items you have to tell me. Number of items are there, not one or two, number of items are there. You write down in your book, what are the items that you can see. What are the items that you can see, you have to write down in your book. Number of items are there, not only one item, number of items are there. Please go through the adjusted trial balance and tell me what are the new items that you can see. Tell me what are the new items that you can see. I had shown you the unadjusted trial balance in the last slide. Now you have to tell me what are the new items you can see here. And write down, you can write down in your book, you can write down in your book. You can write down the items in your book. What are the new items that you can see in this adjusted trial balance? These new items relate to adjusting entries for accrual and deferral. Please study the adjusted trial balance. Please go through the adjusted trial balance and then list down which are the items which are adjusting entries, which are the items which may be called adjusting entries. Which are the items that may be called adjusting entries? Please write down in your exercise book. Please write down the items in your exercise book. Okay, Prenika from Sector 12, Faridabad. Prenika. Please adjust the camera, I am not able to see you. Prenika from Sector 12.
Hello.
Please adjust the camera. Yeah, now tell me, what are the new items? Please tell me what are the new items. Unmute your mic and speak.
Hello.
Yeah, I can hear you. Tell me. I can hear you. Tell me.
So sales revenue.
Pardon?
Sales revenue.
Sales revenue. Anything else?
Rent revenue.
Pardon? Rent revenue. Okay. Anything else?
Yes, sir. Cost of the goods sold.
Pardon? Cost of goods sold. Okay. Anything else?
Sales expense भी है.
Sales expenses.
Yes, sir.
Anything else?
No, sir.
Okay. Thank you so much. Shivani from South Extension. Shivani from South Extension. Can you tell me what are the new items that you have seen in this unadjusted trial balance, adjusted trial balance? Shivani from South Extension. Can you tell me what are the new items you can see in this adjusted trial balance? These new items are called the adjusting entries. Please unmute your mic so that I can hear you.
Hello. Hello.
Yeah, tell me. Tell me, I can hear you. Tell me.
So unpaid rent value, depreciation expenses.
Okay.
Common stock. Accounts reliable. Inventory.
Okay.
Furniture and features.
Okay.
Not payable.
Okay.
That's it, sir.
That's all?
Yes, sir.
Okay. Okay. Shubham from South Extension says allowance for uncollectible item. Guest 3 from Saitanagar says bad debt, depreciation, interest payable, allowance for uncollectible account, retained earnings, accumulated depreciation. Ritu Parmar from Fun Bazaar says allowance for uncollectible account, salary payable, interest payable, rent revenue, salary expenses, rent expenses, depreciation expenses, interest expenses, bad debt expenses. Okay, very good. Okay. So various items are there. As you can see, bad debt expenses right at the bottom of the adjusted trial balance. From the bottom, as you can see, bad debt expenses, interest expenses, depreciation expenses, rent expenses, supplies expenses, salary expenses, various items are there. Allowance for uncollectible items, various items are there which have been taken into account for this purpose. So please see the whiteboard. I will show you in detail what are the items which are taken into account. I don't know whether you are able to see, there is some okay, now it is okay. Anyway, yeah. So bad debt expenses, supplies expense, rent expenditure, unearned rent revenue, depreciation expense, salary expense, interest expense, all these items are there which are the adjusting journal entries. Bad debt expenditure, then supplies expenditure, rent expenditure, unearned revenue expenditure, depreciation expenditure, salary expenditure, interest expenditure. So debit bad debt expenditure, credit allowance for uncollectible account 500, debit supplies expenditure, credit supplies account for 800, debit rent expense, credit prepaid rent account 2000, debit unearned revenue, credit revenue account 250, debit depreciation account, depreciation expense account, credit accumulated depreciation 200, debit salary expense, credit salaries payable for 5500, debit interest expenditure, credit interest payable for 333. So these are the various items which are there. So we'll go back to the slides. So these are the various items. There was some disturbance, but more or less I have given you all the items. So all these have to be accounted for. All these have to be accounted for to get the adjusted trial balance. So all these items are called adjusting entries. All these items are called adjusting entries. I will again tell you for your sake. Debit bad debt expenditure account, credit allowance for uncollectible items 500 rupees. Debit supplies expense account, credit supplies account for 800 rupees. Debit rent expenditure account, credit prepaid rent account 2000 rupees. Debit unearned revenue, credit rent revenue 250 rupees. Debit depreciation expense, credit accumulated depreciation 200. Debit salary expense, credit salaries payable 5500. And debit interest expense, credit interest payable 3333. So these are the various items which are there. So already I have told you all these items, whatever items are there, I have already given you the list. Mayam from DCP says, please show the page again. I am not able to show the page because there is some problem with the projection. That is the reason why I am not able to show the slide again. So if you want, I can. Can you see? If you are able to see properly, just see whether you are able to. Okay, now it is very clear. Now it is very clear. You can see it. Now it is very clear. You can see it. Debit bad debt expenditure, debit supplies expenditure, debit rent expenditure, debit unpaid rent revenue, debit depreciation expense, debit salary expense, and debit interest expense. So these are the items which are there. Okay, so more or less I think you have seen the various items which are there. So basically what you have to do, the main purpose is that all adjusting entries, that means any revenue or any expenditure that has fallen due, that has to be taken into account. That is the most important thing that you have to understand. Accrual and deferral, all these have to be accounted for at the year end or the closing date. Now income statement. The following represents the income statement that summarizes the result of the profit generating activity of the company. So how is the income statement? So you can see on your screen, sales revenue minus cost of goods sold will give you the gross profit. Sales revenue minus cost of goods sold, you will get the gross profit. Other expenses, salary, supplies, rent, depreciation, bad debt, this is the total operating expenses, 14,000. If you reduce 16,500 from 14,000, operating income comes to 2,500. Other income or expense, rent revenue 250, interest income 333. So net is minus 83. So the net income that you get is 2417. So in the case of income statement, that is profit and loss statement, first what is the total sales revenue? From that you have to debit cost of goods sold and the amount you get, that is the gross profit. From the gross profit, operating expenses have to be debited and you get the total operating income you will get. To the operating income, other income and expenses have to be added or subtracted, and finally we get the net income. So this is the income statement. See the balance sheet. This is the balance sheet. So in the balance sheet, please remember one important thing, that assets and liabilities are divided into two parts, current and non-current. Current relates to a period of up to 12 months. Non-current relates to period of over 1 year. So you can see the current assets, cash, account receivable, less allowance for uncollectible items, 1,500 net, supplies, inventory, prepaid rent, total current asset 131,200. Property, plant and equipment, furniture and fixtures, less accumulated depreciation, net 11,800. Total assets 1,43,000. So this is the asset side of the balance sheet. This is the asset side of the balance sheet. This is the asset side of the balance sheet. Please see again, we have divided into two parts, current assets and non-current assets. Non-current assets mainly relate to PPE, property, plant and equipment. Current asset and non-current asset. And have you seen one important thing, the contra asset account, allowance for uncollectible account, that is a contra asset account, accumulated depreciation, that is a contra asset account. So this, from these amounts, the net amount is found. From these amounts, the net amount is found. And this is the liability side. Similarly, in the liability side also, current liability, non-current liability and equity. So current liability you can see, account payable, salaries payable, then unearned revenue, interest payable, note payable, total current liability 51,583. Then long-term liabilities, note payable 30,000, equity stock, common stock plus retained earnings 61,417. So total of liabilities comes to 143,000. So you can see that the asset side is equal to the liability side. And both assets and liabilities you have to divide into two parts. the current assets and non-current assets, current liability and non-current liability, including stock. What are permanent accounts? Real accounts. They report activities relating to one or more future accounting periods. Permanent accounts. They carry balances to the next accounting period and are not closed. That's why they are called permanent accounts. They are also called real accounts. So such type of accounts relate to asset, liability, equity. These accounts are carried forward from one accounting period to the next. That is the reason why they are called permanent accounts. Next, temporary account. Temporary accounts are also called nominal account. Temporary accounts are also called nominal account. These relate to the revenue and expenses. So, they accumulate data related to one accounting period. For one accounting period, these relate to one accounting period. So, profit and loss account, profit and loss statement, this will relate to items of revenue and expenses for one accounting period, 1st of April to 31st of March. So they accumulate data related to one accounting period. Second point, they include income statement accounts, the dividend account and the income summary account. And these accounts are closed at the end of the period to get ready for the next accounting period. So all temporary accounts are closed at the end of the accounting period and they begin the next accounting period with zero balance. So this is the accounting cycle. You can see already we have discussed this. Start, analyze transaction, journalize, that means enter in the journal, post in the ledger, then prepare unadjusted trial balance, adjustment entries, post adjustment entries, prepare adjusted trial balance, prepare statements, close entries, prepare post closing trial balance. So this is in a short form, the entire process is given here. So you can see what is here. Temporary accounts. What are temporary accounts? Revenue and expense accounts. And income summary account is the difference between the revenue and expenditure is transferred to the retained earnings account in the equity section of balance sheet through the income summary account. So the revenue accounts are debited, income summary account is credited. Income summary account is debited, expense accounts are credited. So at the end of the accounting period, all revenue accounts and all expenses account will become closed, have zero balance. And whatever amount is there in the income summary, whether it is profit or loss, that is transferred to the retained earnings, that is which is shown in the equity section of the balance sheet. And in the next you can see the permanent accounts. Permanent accounts are three types: assets, liabilities, shareholders' equity. That's it. So steps for recording the closing entry. First, close revenue account to the income summary statement. Close expense account to the income summary. Close income summary to retained earnings and close dividend account to the retained earnings. So these are the four steps which are there in this closing entry. First, close all revenue accounts. Second, close all expenditure accounts. Third, close the income summary account and transfer to retained earnings. Then close the dividend payable account to the retained earnings. So closing revenue accounts to the income summary account. The first step in the closing process is to transfer all the revenue to the income summary account. For example, you can see here, this is just an example. you can see salary expense and revenue expense and retained earnings and income summary. So 4 accounts are shown: salary expenditure, revenue expenditure, income summary account, retained earnings. 4 accounts are shown. Now let us see how the transactions take place. First, as you can see, debit revenue expenditure 25,000. You can see the red arrow. Debit revenue account 25,000. Credit income summary account. Debit revenue account for 25,000. Credit income summary account. You can see the red arrow. So the revenue account becomes 0. Next you can see debit expenditure account, credit expenditure account to the debit of income summary account. Debit income summary account, credit expenditure account. You can see that arrow. You see the figures only. What is written you need not bother. See the arrow, red arrow. Please see the red arrow. Debit income summary account 18,100, credit expenditure account. So expenditure account becomes 0, and we are left with 2 amounts in the income summary account. One, 18,100 in the debit side. Next, 25,000 in the credit side. Next, the net income for the period is 6900. Net income for the period is 6900. This balance must be transferred to retained earnings. So whatever profit is there, that is transferred to the retained earnings. As you can see, expenditure revenue account becomes 0. Income summary account, what is the net amount? 25,000 minus 18,100, that is 6900. Now, debit income summary account for 6900 and credit retained earning for the same amount. Balance in the income summary account is now 0. So as you can see, income summary account, debit income summary account, credit retained earnings 6900. Previously, opening balance of retained earnings was how much? 7,000. That is still there. That is still there. So what have we done? The income summary account, we have debited for 6900 and credited retained earnings, that is part of the equity section of balance sheet for 6900. So in the retained earnings, we are having 7,000, that was the previous balance, and 6900, that is the present balance. Next, whatever dividend payable was there, we have debited dividend payable account and paid the dividends. So debit dividend payable account, debit retained earnings account, and credit dividend payable account. So you can see the arrow 2000. The last step is to close the dividend account. This is the last step. Close the dividend account with a credit and debit the retained earnings for 2000. The balance in the dividend account is now 0. So what happens? There is a dividend payable account. We debit the dividend payable account and pay the dividends. And retained earnings is next debited and credit. We make the credit to the dividend payable account. So you can see the red arrow. Debit retained earnings 2000, credit dividend payable account 2000. So that is the end of the accounting. No more accounting is left. So finally, what do we get? You can see the right side, retained earnings, 7,000, 6,900, total comes to 11,900 if we minus the 2,000. So on the credit side of retained earnings, 13,900, on the debit side of retained earnings, 2,000 is there. So what is the net balance in the retained earnings? 13,900 minus 2,000 comes to 11,900. 11,900, you can see, determine the ending balance, determine the end balance in the retained earnings. So these are the steps that we follow. First, what do we do? First, we debit all revenue account and credit income summary account. Next, we debit income summary account and credit all expenditure accounts. So, expenditure and revenue account becomes 0. Now, whatever difference is there in the income summary account, that is transferred to retained earnings. And finally, whatever dividend payable is there, that is debited to retained earnings and credited to dividend account. And whatever net amount is there, as we can see, 11,900 is the net amount in the retained earnings. Post-closing trial balance. The trial balance is prepared after closing entries have been posted. The purpose is to ensure that all nominal or temporary accounts have been closed. That is the main reason for obtaining a post-closing trial balance. The only account in this trial balance should be assets, liabilities, and equity accounts. The purpose of this post-closing trial balance is to ensure that the trial balance does not contain any income and expense items. So this is the post-closing trial balance. I'm not going into details. As you can see, in the post-closing trial balance, no nominal account or no temporary accounts are not there. Only permanent accounts are there. What are these permanent accounts? Assets, liability, equity. No other accounts are there. That means all temporary accounts are closed and do not find a place in the post-closing trial balance. So what have we learnt in this session? It is mandatory for listed companies to prepare and publish financial statements annually. Second, trial balance is a statement of all general accounts with the names and respective balances. Revenue recognition principle requires the revenue to be recorded when earned, neither before nor after. Before I end the program, let me tell you, first cycle test is tomorrow. Please attend the cycle test and all the best for you. And before you go away, please don't forget to give your feedback. So we are ending the session. Please give your feedback. Thank you.